to another edition of the Energy Week podcast. Ryan Ray alongside Dr. Energy herself. And Dr. Energy, it sounds like you and Dr. Earth, her Mother Earth, went to battle the last few days with Snowmageddon up in Boston. How are you doing?
Well, now that I'm back in the South and it's about 66 degrees instead of a grand total of 5 degrees, I feel like I executed a strategic retreat.
Mother Earth takes this victory, but she'll be back.
Oh, yeah.
Well, it is good to be back, and we got Dr. Dean Foreman on this week. And just a quick programming note, may or may not have an episode next week due to some traveling and conflicting schedules. So if we're not here next week, we will be back the week after that, which would be February the 4th. So I will say this, Leon, it is good we recorded on Tuesday and not yesterday. I was in a bit of a funk after my Saints were just robbed.
Oh, God. That was awful. That was the worst. I've seen a lot of bad calls. That was the absolute worst thing. They were robbed.
It's an embarrassment, but it's what you gonna say? So I had to go back to Louisiana for some stuff, and I was watching my dad's house, and it just was like, oh man, it was a tough pill to swallow. But guess what? We have an Elon Musk article that will brighten my spirits up. But let's start first with Bloomberg. I saw you were actually tweeting about this right before we got on here as well. There was supposed to be a big meeting this week, but it seems like nobody is going. Are you? Well, I guess you're not going, right?
Oh, no. It's funny. You're the second person to ask me if I'm going to Davos. And I got to tell you, I'm nowhere near important enough to go to Davos. I mean, like, let's get real here. So, yeah, no, I'm not in Davos, not going to Davos. In fact, some really important people are basically boycotting Davos. In fact, I was asking, is Davos dead? Really?
Yeah. I saw that.
The Americans aren't there. The British aren't there. French aren't there. I mean, like, what's the point?
Yeah.
I mean, other than skiing.
That's a good point. So one of the things that caught my attention about this article was it kind of emphasized that the Saudis and the Russians won't be able to sit down and have their first face-to-face meeting. To me, that kind of goes back to one of the things we talk about a lot is, okay, there's a lot of formality and things like this. At the end of the day, that doesn't seem to be a big deal. It just seems to be more of a bigger deal that everyone's kind of bailing on it. Now, Trump seems to be, because of the government shutdown, should we read anything into the Saudis and the Russians not going, or is it just kind of, hey, you know what, we got things going on right now?
Yeah, I mean, I was thinking about that. I was saying, like, is there something to read into this that Al-Fali is not going to go and Novak is not going to go? But not just are they not going, but they're not going to have this meeting where they were apparently going to discuss the production agreement and oil markets and all of that great stuff, and probably some of their own joint pursuits. And is there something to read into this that maybe they're not so bro-ish as they were before? And I'm not necessarily sure that that's the case. I mean, you definitely could read into it, particularly given Novak's earlier comments, where he is basically saying, like, they want to formalize this cooperation agreement. And Novak said something along the lines of, well, it's not, we don't really see a reason to have any, formalized agreement, which makes perfect sense for the Russians, because why ever would they want to bind themselves into anything when right now they hold the upper hand in all of this OPEC business? I mean, Novak's really played his cards well, and maybe this canceled meeting is actually a reflection of the fact that Novak is no longer interested in pursuing this this formalized group, which apparently they're supposed to meet and talk about in like March, I think in Baku, in Azerbaijan. So you could read that into it, but I think it's more a factor of, I think it has more to do with the overall lower attendance. I think it's more a symbol of or signifies this issue where you've got all of these big time leaders. I mean, basically like half the leaders of the free world or 2/3 of the leaders of the free world are not coming to this, mostly because they face instability at home in large part because of populist movements. I mean, in the US, you've got this government shutdown that's really fueled by competing populist movements. You've got Theresa May in this Brexit fight that won't go away and isn't solved. And she just had this no confidence vote last week, which she survived probably only because nobody wants Jeremy Corbyn to run the government. Not because they have any confidence in her ability at this point, but because he'd be even worse. And then Macron's got this insane situation with this gas tax and these riots. So, you can see if you look at that, and then you can look at Al-Fali, he's probably thinking to himself, look, I got better stuff to do. Mm-hmm. Like the big guys aren't going to be there. Is it really that important for me to show up to this when I've got all sorts of other stuff on my plate, better things to do? Why, is it really important for him? I mean, he's a big person in the energy world, but he's not like a big person in the like global leadership stage. Right. And if he's not going to have the opportunity to hobnob with the big timers, then like maybe he's like, I got other stuff to do.
No disrespect to Japan and Germany and Brazil, who will be there. When we say the big ones won't be there. Yeah. But the big ones won't be there.
Brazil is interesting because he's really kind of come onto the world stage. Right. I mean, look, Merkel, she's retiring. Like, so what? She's going for her like last hurrah to like have a beer with her friends before she goes off to her, country estate.
It's interesting. You brought up, what's going on in France and obviously the U.S. We got the shutdown here, and that's about immigration and border walls, and then you get the Brexit. But it's interesting. We've talked months ago, I guess it feels like now, about this idea of this global community and, being able to buy and sell goods freely across international borders. And yet it seems like in at least some of the bigger quote unquote powerhouses, if you will, there's an instability about how we're progressing right now and how our governments are running our nations right now. And it's interesting to kind of watch this because there's some very heated debates. Now, some people have argued, say, well, the debates in America are because they're the right kind of debates to have because it means you don't really have problems. And I'm not so sure that that's the case. It kind of feels like maybe we're at a point, and I don't want to overemphasize this because it could be completely off the mark, but I kind of feel like we're at a point where maybe the populations, at least in the Western world, are going, you know what? We're kind of re-examining things, and we're kind of figuring out, how we want to be led moving forward. And you see that, I think, with the Brexit deal. Just a few years ago, that was really popular. Now it seems, I'm not in England, I don't know, but it seems like there's a real mixed sentiment on that. What's your kind of take on what's going on in the Western world, if you will?
I think there's been a real backlash from people who felt maligned, I think, by the way things were going for the past almost like 20 or 30 years. And so there was a backlash. And then I think we saw that with Brexit, that the vote in favor of Brexit was essentially a backlash. The support for Donald Trump is a backlash against that. And then now we're seeing a competing backlash from the other side. And so, I kind of do see it like that. I think France is maybe they're experiencing that backlash now. They're having, these taxes were passed and they're affecting a whole. I mean, I think the France situation I almost see as like emblematic of everything that's wrong with Davos to begin with. Like, there was absolutely no, if Macron had gone to Davos, like they should have just like not let him back in the country at all, because it would have been so despicable. Because this is a tax that was, he didn't pass it, his predecessor did, that hurts only like middle class and poor people who don't live in big cities but need to commute. And it hurts them so much. I mean, and so someone like Macron and people who are kind of in the elite, or the people who are all taking their private jets to Davos, would never feel that tax. But for other people, it will literally kill their business.
Right.
And so I think that shows this. And that's like, I mean, I know they like to call the Saudi FII conference Davos in the desert, but it's not quite the same, like the same elitist, like overly rich, ostentatious feel. I mean, I don't know. I guess you could say the Ritz Hotel, where in the convention center where they have it, has that feel in a uniquely Saudi way. You could say that kind of overkill. I mean, the Swiss don't usually have like chandeliers with 10 gazillion crystals and like gold walls and things like that. But in some ways it is kind of similar. And I think that people they understand what it means to be seen there. And in certain cases it would look so incredibly bad that they can't be seen as endorsing it.
Right. One final thing I learned from this article, Bloomberg has a WhatsApp feed, and so it's in the article we will link to in the show notes. So if you read this article, so I'll be signing up for that.
That's actually one other really important thing, is that from what we hear, Novak and Al-Fali talk to each other on WhatsApp all the time.
Right.
These guys are all WhatsApping. So maybe they're like, oh, why do we want to go to this place where you have to walk around in the snow? And
well, you got to deal with reporters and scrutiny, and instead of going to your, go somewhere and mind your own business, and no one ever knows. Okay, let's go now to Reuters. Japanese refiners load first Iran oil cargo since U.S. sanctions. We've got a follow-up story. I guess we'll kind of merge these together a little bit here, because Iran fails to find any buyers for crude offered on exchange. So on one hand, you kind of say, well, this is a good note for the Iranians, but on the other side, it's kind of maybe it's okay for now, but in the long run, they're not going to be able to overcome this issue.
Yeah, I thought it was interesting because first of all, Japan had completely stopped purchasing Iranian crude oil. And so like to restart is a big deal. And they actually gave some interesting information about why they took so long to get restarted. And the reason is that they were having trouble finding banks to handle the payments. But the other really interesting thing that we learn here that I think really will impact the future is that apparently the Japanese government has been providing the tanker insurance for these tankers of Iranian oil. And that insurance, it's not provided by the Japanese government, but it's backed by the Japanese government. And that tanker insurance is going to expire in March. So unless the Japanese can get another backer, I guess, for to back that insurance, this could be the first and last cargo of Iranian oil to go to Japan, because they finally got it started. It's going to arrive in February, and if the insurance expires in March, the Japanese aren't going to import more without insurance. So some people will import without insurance. The Japanese are not those people. So, I don't think we can necessarily extrapolate based on this into the future that Japan is going to be using all of its quota. And in fact, it may, I wonder if they're just going to give up on that come April or May, when the United States reviews those significant reduction exemptions, they may just say, well, Japan's not going to we're not going to renew it for Japan because they're not importing anyway.
But okay, so let me ask you this: Japan, I know a lot of their energy is dependent on, and this is kind of an interesting geopolitical military strategy type debate I've heard people go back and forth on. Is Japan is really dependent on folks who are sometimes U.S. allies and sometimes aren't, to put it mildly.
Yes.
How much is that weighed into this decision? Because you have just kind of the dollars and the cents and logistics and all this stuff, but how much is it the Japanese are like, hey, look, we're big time allies over here. We've got to get this done.
You know, that could possibly be it. I think that they are I think part of it is like they don't necessarily need it. They were happy to import it when it was easy and cheap, and if it's not easy and it's logistically difficult, they're going to get it from elsewhere.
Right. Well, I saw the article said that they're their fourth largest of Iran's importers and so, or buyers rather. So I just didn't know, it could be fourth largest for Iran, but on Japan's side, it could be pretty insignificant.
Yeah, I mean, I know they get a lot from Saudi Arabia. I think they also get from Kuwait. They're big buyers from Kuwait as well, I think. So I wouldn't be surprised. It's interesting. I mean, I think that as long as they could find a bank to do it, they had no reason not to do
Right.
it because it's cheap. But without the insurance, it's just interesting that unless the Japanese government, I guess, decides to roll it over or extend it, they're not going to do it. I don't think they'll do it without the insurance.
Yeah, all that stuff yeah. I'm not sure, and it feels like on the Trump side of things, that I don't know. I think you wrote a piece on this. Let's start there real quick because we got Foreman coming up. But you did write a piece on this on the Platt stuff we talked about last week for Forbes or something. What is your feel on what Trump's going to do here in just a few months?
Yeah, I think they're going to get rid of at least some of the SREs, particularly for the ones that really halted payments or that, sorry, halted imports and the ones that never resumed. So I wouldn't be surprised if they just nix them entirely. But I do think that it depends in large part on the price of oil, and they're not going to be able to depend on Saudi Arabia to be bullied into producing more. So I really do think that for China and India and some of these other places, it's going to depend really on the price of oil.
Okay, and real quick on that, this is according to worldstopexports.com. Japan imports, as you mentioned, number one, the Saudis, number two, the UAE, number three, Qatar, four, Kuwait, five, Russia, six is Iran. They spend, so for perspective, they're spending 25.6 billion a year in dollars. It says the Saudis, they're spending 3.5 billion to Iran, but then after that it drops down to 1 billion to number seven, Iraq. So they're kind of in there with the Qatar to Kuwait, Russia, Iran are kind of all in there about the same level, according to this website, at least for what that's worth. Okay, I mentioned it a minute ago. We have to lift my spirits. We asked Mr. Musk for an update, and did he deliver? He delivered.
Oh, yes.
With a note talking about layoffs. And you know what? I got to be honest with you. We always kind of poke fun at him and critical of him, but I felt like at least the first 2-3 paragraphs or whatever it is of this article, this email he sent to his police, he was actually pretty honest. He said at one point, let's see here, we delivered almost, however, thanks to your efforts in 2018, 2018 was also the most successful year in Tesla's history. We delivered almost as many cars as we did in all of 2017 in the last quarter alone, and nearly as many cars last year as we did in all the prior years of Tesla's existence combined. And I was like, exactly! Exactly! Y'all never made any cars!
Oh, God. Oh, God. Oh, God. Oh, Elon Musk.
I don't think he meant it like that, but when I read it, I'm like,
Yeah.
yes, exactly. He did say in Q3 last year we were able to make 4% profit, while by most standards, I
Oh
would
my
still
God,
consider
4%.
Yeah, I would still consider
Q3.
right. And he said I would still consider this our first meaningful profit in 15 years, and I was like, exactly, exactly. This is what we've been screaming about. Now, I don't want to kid too much if people do lose jobs. That's always a serious situation that is sad. So, All kidding aside, he is going to cut their headcount by 7% on the full-time employees. What the article doesn't say, or if I missed, or the email doesn't say, is they're going to retain only the most critical temps and contractors. That could be a significant number because I don't know how many temps and contractors they have, but theoretically that could be a lot of people.
Yeah, more than some. Yeah, that's a good point.
It could be less. I just don't know. It's hard to tell.
Yeah. But what does this say about their future for production, really? I mean, that's the real question. What does it say about their ability to produce these cars in the future?
Yeah, well, okay. I'm glad you brought that up because he said in the email, he says we grew by 30% last year, which is more than we can support, and so they're going to reduce by 7%. I guess of that, and so they're going to reduce 7% of the whole. They grew by 30%. So you can look at all that and say, well, I don't know what it means because you had to grow 30% to keep those numbers up. So with this 7% reduction in full-time employees and temps and contractors, unless it was some kind of workflow issue, it feels like you're going to be back to where we were before, which was hit or miss.
Oh boy.
I don't know. I'm just guessing here.
I can't wait for the next earnings call.
Yeah, I don't. Yeah, what you gonna ask him?
Elon, what kind of sunglasses do you wear?
Exactly. I do need to say this, Ellen. I just sent you an email. We had a listener, Charles. I won't say his last name, but a listener sent in a link to a podcast. We talked about the IMO 2020 standards, and he sent a link into a podcast that covers that. And so I said to Ellen, we'll include it in the show notes. It's a 7-part breakdown of these IMO 2020 shipping standards. So thanks, Charles. He listens to the show. We appreciate you listening and sending that in. So listeners who are curious about that, it's a good resource for the IMO 2020 changes.
Not just listeners. I really need to get up to speed on that.
Well, and I'll add that to I didn't want to admit my fault there, but yeah, I need to be listening to this.
I will admit, I'm not going to pretend to know what this means and know the implications. And it's one of those things that I have on my list to, get down dirty in there, but I just haven't done it yet.
Well, we will include a link to that in the show notes. So, all right. And for the first time in 2019, we have on Dr. Dean Foreman, the chief economist with the American Petroleum Institute. Dr. Foreman, Happy New Year. How are you doing, sir?
Happy New Year. Glad to be here. I'm doing great. Thank you.
And as always, we're going over a report that you guys issue. We'll link to that in the show notes. This is the monthly statistical report for this month for January, which will be published on the 25th. The executive summary starts out with mentioning that we set a bunch of records in December. And as I count them here, 1, 2, 3, 4, 5, 6. We set 6 records in December. Is setting 6 records a record in of itself? I kind of was wondering because there's a lot of positive records that were set.
It's a great question. I mean, we really did have a strong year, and some of these records reflect the year as a whole as opposed to just a month, and some of them are for a month. So, it's fair to say there's a lot to be proud of, but at the same time, December also raised some questions for us because we saw the big price change with prices coming down, and frankly, for things that we've talked about in previous episodes that are extraneous to the economy, like fuel. Seeing the weakness in that was actually.
One of the things I found of interest was looking at your report. You talk about there's some good news and some bad news. Is on some things we set record for demand, it seems like, and then on other areas it's like, well, this was a record almost for a lack of demand or seasonal low. How do we reconcile? We're looking at the oil and gas market. We see on one hand, okay, you know what? It's not that everything should be hot all the time. But we see that, okay, for December, this particular maybe jet fuel or whatever is doing really good, and compare it to this other one that's doing really bad. And the historical mark, how do you guys look at that and say, well, some signals are good and some signals are bad?
It's a great question. And the short answer is that things like heating fuel oil, are highly seasonal. But when we start looking at gasoline demand, we know there's a driving season and a traffic season, and we can compare year to year and say, is it strong? And for gasoline demand, it's been great. Distillate, the increase in diesel fuel that we saw year to year was actually quite phenomenal. So those things, but when you get to about both people's confidence and willing to spend and travel, as well as the freight shipping of, so much more is shipped by air for goods from Amazon and other things these days. So as that happens, that also is a pulse of what's happening as a current economic indicator. So that plus prices generally. There are times when oil prices tell us a lot about the global economy, which, frankly, you had the IMF coming out this talking about lowering their expectations. We've, in these reports, quarterly reports, been highlighting this potential for weakness for the last 2 quarters. So this is, to us, it's coming to fruition, and we're seeing it play out in a way where, don't get me wrong, it's still a strong story for energy and for U.S. potential to grow the economy in these areas. But as we're seeing it play out, we've got questions and we've got things that have to move forward and improve on the trade.
So I had a bunch of really interesting things that I noticed that I'd love to ask you about. One of those things was the refinery capacity utilization, which API said is that 95% is in December. And I was wondering, do you see this as a reflection of crude oil availability or low prices and gasoline demand, or has America's refining situation improved since 2015, or are refineries actually running themselves to the brink? Should we be preparing for some sort of significant maintenance season that could impact crude oil draws and stocks?
It's a great question, and I think at this point you would say that the companies have been investing in their maintenance, and that's been, we saw some turnarounds this year that were part of the regular turnaround schedule that would go with that. So it's more a function of their responding to the demand for the products, both domestically and internationally, and frankly, in the way they've invested in expanding their capacity and utilizing that capacity. It's enabled things that are close to record levels, that were at record levels for utilization. And you'll notice something that we've done in this month's report. It's the first time we've nailed an economic indicator on behalf of the American Petroleum Institute. We're calling it DEFI, a distillate economic and financial indicator. And it's a combination of industry fundamentals, including refinery capacity utilization, refinery throughput, as well as for diesel or distillates, the demand and the inventories and the relationship of how those are changing. You add some oil prices and some interest rates into that, and this is highly predictive of where industrial production and the economy are.
I was actually going to ask how
you're seeing in this data.
I was going to ask, how should our listeners use this new indicator? You said that it's highly predictive of industrial output and industrial health, but how should listeners use this new indicator?
So if we were comparing it to other indicators of industrial production, the Institute of Supply Management Purchasing Managers Index is an example. Based on our testing, we should outperform that as a predictive indicator of where industrial production will go. Now, industrial production is not a predictor for oil price. So let's be clear that we would never even pass legal muster and be able to put this together as a trade association if we were saying this is going to predict prices. But it's a pure economic indicator, and as people that are interested in energy's relationship to the economy, this is reinforcing the importance of how it goes through the value chain, what types of industrial activity we should expect, and frankly, the fact that there's momentum in this when we're going 1 and 2 quarters out, up to 3 quarters, we see a lot of traction and correlations with how industrial production year on year tends to change. And right now, again, we're coming from very strong levels. It is showing forward.
So my next question had to do with Mexico and how their fuel crisis has possibly affected U.S. gasoline numbers for December, and how we might expect or see this changing in January, given Mexico's new policies about stopping using their pipelines.
Great question, and I think you're right from a monthly standpoint that there can be some short-term impacts that show up there. Now, the broader thing about the policy shift, though, the desire on behalf of Mexico to expand their own domestic ability to provide refined products, so basically build refineries, will take many, many, if not tens of billions of dollars and a lot of time to execute. It's not so clear that, despite the aspiration, that they have the resources or the wherewithal to make that happen, though there are companies internationally and based in the U.S. that are willing to cooperate and take advantage of this almost once-in-a-generation opportunity in Mexico with the opening of the energy sector, both upstream and downstream, as well as the pipeline midstream capabilities, to invest and be able to participate in that. So look, the future's bright. There is a lot of energy potential there, but to take their own crude and convert it domestically, at this point, it's going to be a lot more cost effective to do what they've done this last month, which is continue to take U.S. product, just ship it across the border.
Right.
And right now, we are the most cost effective in the world as a refining business in doing that.
That is really interesting. Okay, I get two more questions before I'm going to turn it over to Ryan, because this was a really interesting report. So one of the things, everyone's talking about the economic slowdown in China, but I was reading recently and that some oil executives are saying that they don't think that this is really going to have that much of an impact on oil demand as maybe people have been saying. They're not really making any changes. And so I was wondering, what does this possible industrial slowdown in China mean for U.S. oil exports, potentially?
Well, China is the pulse. It's the indicator, if you will, of on its coattails rides all of emerging Asia. So you start to look at what's really the outlook for global industrial production, global consumption, export-led growth. There are a lot of aspects that go with this when we read the tea leaves on what's happening with China. And keep in mind that the way China measures its economy, unlike most of the rest of the world, which as advanced economies, OECD economies, Organization of Economic Cooperation and Development, we tend to use expenditure-based measures where we look at different segments of the economy and basically what they're spending, what they're investing, what the government's doing, and then the trade balance on top of it. China doesn't do that. They look at an industrial production-based methodology that's based very much on surveys across the various provinces. And when you base it on industrial production, again, the importance of measuring that for a very industrial production-oriented economy, Goldman Sachs had a paper some time ago that likened what you see out of China's measurement as excessive smoothing. It's never, at the time that it's booming, it's never as high as the highest high. But at times like now, where it appears that there's a downturn, they're never reporting growth as low as the lows either. So back during the Asian financial crisis of 1998, when they were still reporting growth basically of 6%, the actual estimates were closer to 3.5% as far as what, based on other indicators, the economy was actually doing. And now that we see them reporting growth of more like 6.5% and expected consensus-wide to come down into the lower sixes for this coming year, when we look on a market exchange rate or actual exchange rate basis and convert the economy globally into U.S. dollars, roughly for the last few years, we've seen oil demand growing at about half the rate of the global economy. So to answer your basic question about what this means for oil demand, look, it's not a tectonic change in terms of the amount of oil, but it's enough because it doesn't take big quantity shifts to affect relatively large price shifts in oil. And that's what we've seen actually quite recently, and the market's starting to factor that in.
And so do you think that means that China may be importing less oil from the United States? I mean, one of the things that we've been hearing for a long time about is China's converting more to a consumer economy. More people own cars. They want to drive. They need more gasoline. So is China still going to be importing, a lot of crude oil to meet gasoline demand, even if it's not using it for industrial purposes?
Well, if we go back a couple of episodes where I joined you, Ryan, you'll remember with the trade data that as of June, China was purchasing about $1 billion a month worth of U.S. crude oil and products. And then by August, they stopped doing so. And for 3 months, they didn't purchase hardly anything. Now, there are no trade data right now because of the government partial shutdown. No trade data, detailed trade data after October. But what we know as of October was that China was still not purchasing U.S. crude oil. Now, I can tell you separately, as API, we've been having discussions trying to support government negotiations related to the trade representative and the public negotiations about what's happening. Will there be a trade deal between China and the United States? And if so, on what terms? I think net, the basic tenet to take away from this is that China's getting the crude oil it needs by going to Iran and other sources in the Middle East, within Asia Pacific. And because oil flows and it changes hands, the fact that the U.S. Feeds this supply, these record 2.4 million barrels per day of crude oil exports to the U.S. into the global market, is basically feeding the global supply demand. Whether or not China actually decides to buy it doesn't matter so much here. It may matter more, as we talked about, in the liquefied natural gas or LNG market, where it's not as fungible. But especially from the oil perspective, the market's working, and we've seen this big response where as inventories are building and demand appears to be slowing a bit, the prices have come down quite a bit.
And that it leads exactly into my last question on our our kind of our quick round of questions. So inventories, you reported, are near the top of the 5-year average. And this is exactly the metric that OPEC has been targeting. And they want to see global inventories below the 5-year average. But meanwhile, we're getting U.S. inventories back up there. So has all of this hard work by OPEC meeting and trying to get people to cut, has this all been a failure? Should we say, OPEC, stop wasting your time. Go home.
You follow OPEC and Saudi as well as anybody, and this is really the pivotal thing. Together, they're collaborating and have a good relationship with Russia. They've agreed tentatively to scale back by 1.2 million barrels per day collectively over several months here. It's interesting if you look at whether it's EIA projections or, frankly, OPEC's official projections this month still show Russia increasing its output over the course of the year. And it's hard to see how you maintain the discipline from that perspective when you still have, as you said, this response. So you turn back
apparently
to how much of the U.S. spread.
Apparently, the taps in Siberia are frozen. That's their excuse. They can't turn them off.
That's a great rationale, and we'll see though, because the price is going to continue to respond to it. This last week, we saw a drop of 33 drill rigs. Look, that's not out of 800 something. That's not tectonic, but again, it's the start of a trend. And we talked about last month how the drilled but uncompleted wells are now a record, and they've increased now to over 8,700. So even if drilling pulls back, the U.S. is likely to bring a lot of supply this year, and we're just going to have to see how it plays out.
So on that, a couple things have happened since we talked last. Towards the end of last year, it felt like everyone was feeling pessimistic about the price of oil. This year, it feels like that sentiment, at least on some spots, have changed. And I'm curious, now the report doesn't deal with this, we don't have to go too far outside the report, but how much would you say, if at all, the Fed's commentary since, in December they're talking about raising rates, now it seems like they're not going to raise them, maybe even lower them again, depending on where you're falling at. How much should we look at when we're following stuff? We talk about China, we talk about Russia, we talk about obviously the supply, but what the Fed's doing, and if they do raise rates or if they do lower rates, how much do we need to factor that in as we go through 2019?
Well, the effect of interest rates, and the reason this enters into the economic indicator is as much as, and we look at it as a ladder, starting from risk-free rates, the Fed funds rate, all the way up to corporate bond rates, and that difference and how it's changing tells you something about risk on or risk off. And in page 5 of this monthly statistical report, there is a plot of the EIA's estimate of what all this means for pricing. Now, they would be holding policy or interest rates and everything constant. Net, the interest rates themselves, it has two effects. There's the risk on, risk off, and how that affects market sentiment. But then secondarily, there's the strength of the U.S. dollar. And generally, and sometimes we put a chart in that plots the inverse recent relationship between the strength of the dollar, so a stronger dollar with higher interest rates or expectations of higher interest rates, you get a stronger dollar, tends to suppress or push down prices, other things being equal, and vice versa. So if you were looking at, the Fed might be on hold, or it might even lower the rates, that helps support oil prices. And you've seen from Wall Street some reports to that effect this last week.
Okay. The final thing is, in the report, you note, let me see here on, I had it change pages, page 4, largest 2-month crude oil price since Q4 of 2008. Obviously, it's been a decade since 2008. But you do note that these were the most pronounced 2-month decline since the 2008-2009 financial crisis. Do we read anything into that other than it's just happenstance, or should we be looking at other factors as well at this point?
Well, the market's had a big reaction. It's been sudden, and there are a lot of concerns about an emerging market crisis. When you have the IMF giving its largest ever bailout to Argentina, and also bailing out Pakistan, to Ghana, and talking with South Africa. We've mentioned that out of all of the so-called BRICS, Brazil, Russia, India, China, South Africa, only India is in reasonably strong shape, and then with the slowing in China, it draws all this into question. So the U.S. is relatively insulated. Our growth is expected to slow this year, but not to recessionary levels. It just may feel like it relative to the 3% kind of growth that we saw in 2018. So if the consensus is expecting U.S. growth of, say, 2.5% for this coming year, and that's where both Bloomberg and the IMF are, that's decent. And a lot of the investments, the big ones in our industry and others that have been announced, they're committed to, they're going to have to be finished. So you have billions and billions of dollars of investment that continues to come in to make those projects complete and operational and bringing them online. At the same time, though, consumers, that's the pulse of what we're looking for. And if you get this financial market volatility, it was really interesting at the end of December, where you had Treasury Secretary Mnuchin pulling together a plunge committee that basically enacted some measures that appeared to support financial markets, the stock market, in that coming week, that last week of December. So that has, for now, plus optimism of a potential trade deal, plus maybe softening the Fed's view going forward, has supported markets a bit. But we have to actually see the results. And the one thing that is clear and tends to drive equity prices more than anything else is the trajectory of corporate profits. And right now, it's pretty clear that corporate profits across the board have started to slow. And as the consensus estimates for those, in terms of their growth, slow, the market continues to react and digest that. So that's the box that we're in. And right now, this is one of those times when I think oil prices tell us something about the economy instead of the economy maybe telling us more about oil prices.
Okay. Good stuff as always. First off, we want to thank you because of some rescheduling logistical hoops that you jumped through on our end, so we really appreciate that. We know that you are off-site and working hard and took a few minutes to be with us today, so thank you for that. API.org, if you go there at the top right, it says Chief Economist. We will link to that in the show notes, and there you can see all of these reports we're talking about. The report, particular of today's interest, will be out on Thursday, the 25th. Dr. Foreman has a blog there, and they're all the API reports, statistical bulletins, monthly statistical report, economic outlook can be found there. Dr. Foreman, it was a pleasure to have you on. We'll see you, I guess it'll be a short month for us because y'all kind of pushed this report back due to the holiday and whatnot, so we'll see you in just a few weeks, I guess. All right, Dr. Foreman, that's it. Thank you so much, sir. We appreciate it.
Sounds great. Ellen, Ryan, thank you so much. I always appreciate the
Thanks for coming. Thank you.
Okay. And Happy New Year.
Thanks again to Dr. Foreman with the American Petroleum Institute for coming on. Again, he is, of course, their chief economist. Always has a good report for us, and it's nice, Ellen, to be on the inside where we get it a few days early before the general public. It makes you feel warm and fuzzy when you kind of have access to stuff before other people do. So, if nothing else, I enjoy that aspect of it.
Yeah, and having him kind of unpack it is very helpful because I do like their their kind of executive summary, but still it's definitely the kind of thing that needs unpacking.
Yeah, and it is because you look at it and you go, well, okay, so this demand was high, this demand was low. Like here I am looking at it exactly, the kerosene jet fuel record annual demand, but weakest since December of 2015. And let's see, there was one, and I had them highlighted here. Here it is. distillate fuel oil, strongest annual distillate demand since 2007. It's like, well, so it's, you need someone to come help you unpack on, like, it makes sense that, some things will be weaker at certain points of the year than others, but when you see a historic weakness and a historic strongness, if that, I'm not even smart, right?
Oh, yeah.
It's just like, why do you have these extremes going on there? So, good stuff as always. Yeah. Okay, where will you be this week?
This week, I'm going to be on Forbes and investing.com, and I may be on Bloomberg. I did this is so funny. I was away for the weekend at a family event, and so I got this call Friday from this guy from Bloomberg. He's like, I write this market report, and I want to know if I can get your thoughts on oil prices. And I'm like walking down the road and going into a store. I'm like, sure, I'll talk to you about oil prices in the middle of this random store in Boston. So yeah, I will be there, and I don't know where else. That's it for this week.
Okay. All right. Well, Texas Oil and Gas Podcast, as always, talking about all things oil and gas in the state of Texas and Mexico. And I want to say real quick, on the Mexican fuel line bust, quick inside story here. We went down to Mexico, myself and one of my employees. God, it's probably been 3 to 4 years ago. And we pitched them a service to detect these illegal hot taps. Because it is so, they're like top 5 in the world on illegal hot taps. And it never got anywhere, and I won't speculate on to why that is. It just never got anywhere. But it's been a bad problem down there, and it's really tragic. And I haven't read a lot of the stories. I've seen the headlines. I will just say this on a serious note, that in these situations, from what we were told, that sometimes you've got a cartel member and he goes and does it, but you also have other times where the cartel will go and put someone at gunpoint and threaten their lives to go drill this hole in this active pipeline to do a legal hot tap. And so, it's very dangerous on a lot of levels, and it's very sad, it's very tragic. And so, anyways, I just saw that story, and it was kind of heartbreaking for a lot of levels, but just to think if someone comes and pulls you at your house at gunpoint and says, go drill a hole in an active pipeline, it's think about that. What are your options? I can get blown up or I get shot in the head. You don't really have a good choice here. So it's a terrible spot to be in either way. But regardless, we'll press on, and I would say I'm looking forward to
maybe you should go ahead. Maybe we should go pitch them that service again.
Pitch them again. Yeah. Yeah. It felt, with the new energy reforms in place, maybe they'd be more perceptive. It felt like at the time there were some palms being greased to not necessarily follow up on all of that mess. So, but it is what it is. It's fine. Yeah. Maybe we should hit them back up. But it was a sad story to see. And there was already a problem, as you mentioned, with gasoline shortage down there. We just hadn't had a chance to cover on this show. So, all right, Ellen. Well, it was good to be back, and glad you got back from Boston. And did you catch the Celtics while you're up there by any chance?
It's kind of funny you should say that, because we were really hoping to watch all the Celtics games, and we only managed to see one of them.
Oh, okay.
It's very sad. Okay. Yeah, I know. But next time.
Okay. Well, for the listeners, thank you so much for tuning in. Be sure to check out the API's report, and we will talk to you next week.